So let's move on. Sorry, I'm pushing. How do we record these? If we have a T account, we're going to show that we initially purchased it on the 4th for $3,800. On the 8th, we're going to show that $300 return, crediting our inventory. Then on the 6th, we're going to show, the 4th is the purchase, the 6th is the cost of the freight. We increase our inventory. We return some goods, that's a credit on the 8th. And then when we pay it, we get to credit the discount. All of it shows up in our inventory account. So, revenue, sales revenue, like service revenue, gets recorded when the performance obligation is satisfied. The performance obligation gets satisfied when the goods are transferred from the seller to the buyer, when the title passes, okay? Sales invoices should support each credit sale. So the invoice we receive from the seller or our bill should support exactly what we purchased. So when we record a sale, when we sell goods, we're going to either debit our cash or accounts receivable, and we're going to credit our sales revenue, the amount we got from the sale. If this was our gun from Gander Mountain, cash of $1,000, sales revenue of $1,000. But we have to also do another transaction with it under the perpetual system. We need to debit our cost of goods sold. It's no longer sitting in inventory. It's gone. So we're going to reduce our inventory by our $700, the cost of that gun, and debit cost of goods sold, credit our inventory. 2 transactions are needed to record merchandising sales. PW Audio records the sale of $3,800 on May 4th to Sox Stereo on account. So let's say the merchandise cost PW $2,400. So they're going to debit the accounts receivable of $3,800, credit the sales revenue of $3,800, and at the same time, they're going to debit cost of goods sold for $2,400 and credit their inventory for $2,400. Why? Because we need to record the inventory that no longer is in the books, but we sold. Make sense, guys? So,
hey, when you're doing the recording for next week, we'll see how good at actors you are, because you can pretend you're asking questions to the class.
I won't do that. Anyone want gum? Okay.
Makes sense, guys.
Yes,
You
I'll
say that on the
try.
recording.
So,
Then it sounds like it's real.
sales returns and allowances. So let's say we purchased product, we sold product to someone, and now they're returning it. So when we deal with selling goods and then they're coming back to us, they're returning it, the buyer's returning it, we are going to use a different account to keep track of how many sales were returned. We're not going to use a debit to sales. Why? We want to be able to follow some type of analysis to determine, okay, we actually sold this and it came back to us. So we want to keep track of that separately. Therefore, to prepare the entry PW Audio would make to record the $300 that SOC returned, we're going to show, instead of debiting sales, we're debiting sales returns and allowances, and we're crediting the accounts receivable. We want to see how much is coming back to us. And we're also going to have to do the same with the inventory. We need to now add our inventory back, reduce our cost of goods sold. Assume the return goods were defective. Hey there, Assume the return goods were defective and had a scrap value of $50. PW would then show the sales return and allowances of $300, credit our accounts receivable for $300, and since they're defective, we're not going to take the whole value. We're only going to add back the 50 because that's all they're worth. Make sense? So, the cost of goods sold is determined and recorded each time a sale occurs in a periodic system, a perpetual, both, or neither. We only have been talking so far about the periodic system. So, when we start talking about sales discounts, so we are basically selling product to someone, and it's on an accounts receivable. So we offer to customers a deal or a discount, so we get paid soon. So basically what happens is, when we offer to customers, if you pay within a certain period of time, we are going to give you a break, a sales discount. We are going to show that. We're not going to debit our sales revenue because we want to keep track of how many people take advantage of those sales discounts. So we are going to, as it relates to sales, keep things separated so we really can analyze and understand how our money's coming in. So when we, initially in this case, we sold product of $3,800. We show it as sales revenue, $3,800. When they return $300 of it, we show that we have a sales return of $300. When they choose to take a discount, we record it in a separate account, sales discounts. Here's a good example. Assume Sock Stereo pays the balance due of $3,500, gross invoice price of $3,800 less purchase returns and allowances of $300 on May 14th, the last day of the discount period. What's the journal entry we're going to use to record it? We're going to credit out our accounts receivable. We need to zero that. We're going to show a sales discount of $70. And then we're going to show cash of $34.30. They only paid us $34.30 because they took into account because they paid the bill prior to the discount being up. So we are going to keep track of that, not against sales, but against an account called sales discounts, so we know how many people took advantage of our discounts. Now, there's two types of income statements we can do with the merchandising. One's called a single step and one's called a multi-step. Single step is pretty simple. We just show revenue and then we show all expenses, and cost of goods sold is in all of our expenses. Doesn't really let us know what the gross profit is, but it's easy. So here's a single step income statement. You show your revenues up front, then you show all your expenses, and you have a net income. But the multi-step is what we're going to focus on. We get to see something that says gross profit, which is a key. We then get to separate out the income from operations and come up with a net income. So as you see in the multi-step income statement, we show our net sales minus our cost of goods sold. And that gives us our gross profit. The net difference between what we sold it for minus what we bought the goods for. We get our gross profit. Then after our gross profit, we take into account all of our operating expenses. So those are just normal expenses in our normal day-to-day operations, our salaries, our rents, our utilities, everything we spend for being in the business of a merchandising company. Then after our income from operations, we may have other types of income, gains or losses, that aren't part of operating, but maybe we sold a building, that we report separately and then ultimately end up with net income. So know the multi-step gives you the gross profit, which is the sales minus your inventory, and gives you the gross profit. Then we take into account all the expenses from operating. So here are the key items. Net sales is going to be the true sales, then we subtract any sales returns and allowances and sales discounts. We keep those on separate line items so we can see how many sales were returned. Who's screwing up around here? What are we maybe buying that's defective? Is it maybe a specific salesperson that is getting a bunch of returns? I mean, it just helps them to analyze further what's going on. So we also take into account our discounts. So as you see, the net sales is $460, but we show the line items of what the gross sales were minus any returns and any discounts. Does that make sense, guys? We're just showing more detail here. Then we've got the cost of goods sold, the inventory that is sold, and then we end up with a gross profit margin, our gross profit number. Then we show our various operating expenses in order to be in business. And as you can see here, salaries, utilities, advertising, depreciation, freight out. This is freight that we paid to sell items or to deliver items, sales. And then insurance. So we've got from here then income from operations. Then we may have other income, gains, or losses that ultimately give us our net income. So we've got our net sales, and then as you see, after the cost of goods sold, we end up with our gross profit. So this top section is key and separate for a manufacturing company's income statement. Here we show the operating expenses. These are non-operating items. What can be non-operating activities? Interest, dividends, rent, gains and losses from selling assets. Interest expense, any casualty losses, and maybe having to discard various types of equipment. So our other revenue and gains and other expenses and losses are going to be unique from normal operating procedures. The salaries, the insurance, the expenses of running a company. These are above and beyond what's normally the operating activities. Okay? So, the multiple step income statement for a merchandiser shows each of the following features except gross profit, cost of goods, a sales revenue, or investing activity section. Where does that come from? That's a cash flow statement item. So you're correct. Now what we're going to do is look at how it is different under the periodic